Welcome back to Money Pop. There is a view circulating among seasoned analysts that silver could be heading toward $300 to $500 an ounce. That sounds extreme, especially when you consider silver is sitting near $85 right now, having recently tagged 90 again. But the case being built rests less on short-term swings and more on something far bigger, a structural breakout decades in the making. For roughly half a century, silver was trapped in a range between $4 and $50, 50 years of containment. Late last year, that all changed. Silver burst out of that congestion zone and surged to $120. Admittedly, the 120 level was somewhat phantom, only touched for a few hours or a couple of days. It was not a level silver lived at. A more honest read would be that $100 became the upper end before the metal entered a violent congestion zone full of huge collapses and huge rallies. If you look back at the late January collapse, silver dropped down to $66 by the first trading day of February. That entire collapse was essentially over within 2 trading days, January 31st and February 3rd. Most of the action since then has stayed above that low, with the exception of a brief poke on March 23rd, where price nipped out the February low to run the stops and then immediately exploded back up. If you chop off the extreme highs and the extreme lows, what you see is sideways violence. That is the definition of a congestion zone. The argument is that when silver finally breaks out of this congestion zone, the doubters calling it a top will suddenly find themselves bumping into walls, asking what reality actually looks like. And if a government bond crisis becomes visible to the public, for example, if treasury bonds make new low prices, the flow into gold and silver could turn into a panic flow. Think of it like a wet bar of soap, everyone grabbing for it and nobody willing to sell. If silver makes a new high and gold makes a new high at the same time, where exactly is the resistance on the chart? Now consider the historical comparison. Over the last 50 years, gold has had 2 major bull markets. In 1980, gold peaked at $850. In 2011, it peaked at $1,920. If you measure from the bear market lows that preceded each of those peaks, both bull markets produced roughly 8-fold gains. The last bear market in gold ended in 2015 at $1,050. From that point, we are only sitting on a 4-fold gain right now. That is only halfway to what gold has done twice before. So if gold were to climb past $8,000, that would not be spectacular. That would simply be a repeat of what it has already done in living memory. And interestingly, JP Morgan recently published a fundamental assessment landing near $9,200, broadly in line with that $8,000 zone. Silver, however, is expected to gain multiples of what gold does. Right now, silver is pressing about 2% of the price of gold. It has been as low as 1% in recent years. But if you go back through that 50-year range, the 2 times silver hit $50, it was 6.5% of an ounce of gold one time and 3.1% the other time. So even if silver simply got back to 3.1%, that alone represents a massive percentage gain in silver versus gold. That is why, if gold barely doubles from here, silver could triple or quadruple just to restore its relative value. The technicals suggest this is going to be a dramatic event, not an incremental one. If you thought the move from late last year into this year was rapid, the argument is you have not seen anything yet. This may not be a normal bull market in silver at all. The historical parallels go beyond gold. Look at copper, a base metal, not monetary, stuck between 50 cents and $1.50 for decades through the 1970s, 80s, 90s, and into late 2005. Then copper finally punched up through the top of that boring range. Within several quarters, copper tripled, climbing well over $4 without a headline. There was a sell-off afterward, but copper then lived in a new range, roughly triple the prior multi-decade average. If silver were to do the same thing, you would be looking at $300 to $500, then there is lead. Decades stuck in a range, just like copper. About a year and a half after copper broke out, lead did the same thing, tripling in price within several quarters before settling into a new reality. So the question becomes, why was silver alone capped in a 50-year range when gold, copper, and lead were not? There are arguments and evidence that institutions tried to restrain it. But when you try to restrain a market like that, no matter how big you are, reality eventually buries you. When markets make mistakes, like the NASDAQ at the dot-com top, they often overcorrect in the opposite direction. Silver has been suppressed for too long, and now it is essentially in a tantrum. So do not be shocked if silver simply copies what copper and lead did, or catches up to gold in valuation terms and does so very quickly. This process actually began back in November, so this is not just beginning now. By late summer, we will be several quarters past the point where the silver versus gold spread broke out. That is roughly when the kind of numbers being discussed could start showing up. The focus, though, should be on the miners. They appear to have the greatest dynamic of all. The average investor who does not want to buy silver futures or bullion and who is afraid of silver because of the volatility will buy stocks instead. Some of these stocks pay good dividends. Names like Newmont and Barrick, large institutions will move into the equities rather than the bullion. We are already seeing the relative performance evidence of that shift, with performance readings starting to move toward breakout levels. Once that occurs, you're likely to see a net price explosion in the miners. What we have seen over the last year may look like an explosion, but it is nothing compared to what may be coming. In other words, miners should not be viewed as just a leverage play on the precious metals. They are a leverage play on a leverage play because of the deep undervaluation relative to gold. The recent drop in the metals and the miners did not alter the long-term momentum trend assessment. The only breakage was in intermediate factors, the kind that come and go in a few months. The annual and quarterly momentum trends in gold and silver remain intact. And this corrective process now looks like it is wrapping up. The action of silver and the silver miners late last week, and especially this week on the upside, suggests that the rally inside the multi-month range is not just another rally in the range. It is preparing to break out. The two things still missing are gold itself and the gold miners, including the GDX ETF. GDX got within 2 decimal points of a critical breakout number before backing off. The message is clear: do not return to this week's highs, because if it does, the lid starts coming off. Gold also approached its key number and then pulled back. Earlier this week, gold reached around 4,780 and is now near 4,705. If gold returns to this week's highs again, that confirms the rally takes hold, and that is the rally that breaks through everything overhead. At that point, if you're not in this market already, you may not have much time to think it over, because the move is not expected to linger. The bigger picture is this: the silver move is not being framed as a normal commodity rally. It is being compared to the structural breakouts that reset copper and lead for decades. The argument is that silver spent 50 years artificially suppressed, and the violent price action now may be the early stages of a repricing event, not the end of one. The real signal may not even be silver itself. It may be the shift happening underneath the system, weakening confidence in bonds, momentum returning to miners, and a gold to silver ratio that historically never stayed this distorted for long. Once markets move from disbelief to panic, price rarely climbs in a straight line.